So good evening, everyone. Tonight's webinar, How to Invest in the Stock Market Profitably, is about to begin. I'm Tyler Ballhorn, founder of Stockscores.com, and we're going to go through the basics of my approach to investing. I'm going to show you my tools, talk a little bit about the approach, where it came from, the theory behind it, why it works, and then at the end of the night, we will use the market scan tool, which is the tool I use for position trading, and we'll go searching for opportunities. Okay, so there you can see the itinerary. Let's get right into it. How did I get started in trading? So go back to my second year of university, a long time ago, and I was looking at the stock market. I was in business school, and I felt like I should learn about the stock market as part of being in business school. So I played a stock market game, and I kind of got hooked on it. I wasn't using real money, but I kind of got hooked on it. And around the same time, my group of friends started to invest in penny stocks. We were all students. We didn't have a lot of money. And so we were buying, startup oil companies. I grew up in Calgary, which is oil country in Canada. And so we were trading these junior oil companies, junior mining companies, that sort of thing. And I really enjoyed it. I didn't know what the heck I was doing. I thought I knew something because I was in business school, and I was sort of taking the approach that was taught in school, which was to look at the company fundamentals, study management, all that kind of stuff. And it didn't work. And maybe it didn't work because I was playing companies that didn't have great fundamentals. But I think more importantly, I was, again, because I didn't have a lot of money, I was fairly short-term oriented, trying to just make quick money on stocks that were quite, volatile. I wanted to buy those stocks that were at 30 cents that went to 60 cents. So after about a year or two of that, I had some wins, I had some losses. I wasn't really getting anywhere. And then I sort of took a different view of things. I thought, well, why don't I reverse engineer the stock market? Instead of listening to what my professors in business school were telling me, because it wasn't getting me very far, I just decided just to work backwards. And in doing so, what I was really doing was looking at all of the stocks that had done well, the stocks I wish I had bought, and I wanted to figure out what those stocks did in the early stages of their upward trend. And so I went to remember, this is early stages of the internet, so there wasn't the ease of getting stock charts and that sort of thing back then. So I would go to the university business library. I would look in these books. They would have the charts. They came out every month, I think. The charts of all the stocks that were out there. Plus, I could see all the big gainers and losers on the different Canadian markets that I sometimes tracked. And I then went out and got the charts for those. Now, in the early days, I actually drew out the charts by hand, just to date myself a little bit. When I first started doing this, I was drawing out charts day by day on graph paper and looking for patterns. I think I have a bit of a skill in seeing patterns in things. So I did a little bit of work where I printed off the charts of like 200 of the best performing stocks that I could find. And I started to see that there were certain characteristics that seemed to keep returning over and over again. These are the things I'm going to talk about tonight, because what I was figuring out in my 20s is pretty much still what I do today. More sophisticated today, maybe a little faster, much better tools, certainly. But the concept is pretty much the same. Now, at around the same time, I was in, now, let's say, my fourth year of university, and I was taking this class called Mergers and Acquisitions. And in that class, Mergers and Acquisitions, and this was in the late 80s, early 90s, that was probably the early 90s by this point, we were studying the mergers or the acquisitions of one company by another company, and mainly large companies. So when R.J. Reynolds bought Nabisco, that was one of the mergers of the 80s and 90s. And there was merger mania on Wall Street back then. So you had all these companies buying each other. And what would happen is their stock, when the deal was announced, say RJ Reynolds says, we're going to buy Nabisco for $30 a share. And the day prior, it had been trading at $20 a share. The stock made a big jump, obviously a $10 a share jump up to $30 to reflect the buyout price. And that really intrigued us. We wanted to figure out, was there a way to catch those stocks before the big jump? And so what we did is a statistical study where we looked at all of these big mergers and acquisitions deals, and we did statistical analysis of the trading activity before the deal was announced. And we were looking for statistical anomalies to indicate that there were people buying that stock aggressively before the news came out. Now remember, this is back, before the internet was really popular. We were just sort of starting to use the internet. The time that it took to do this was massive, because you had to download the stock market data from these servers at universities in the United States, and then you had to run it through Excel and do all this analysis and try to calculate whether there was statistical significance. Anyway, turns out there was. On almost every one of these big Wall Street deals where the stock jumped dramatically, often in the weeks, sometimes months, but usually weeks leading up to the big announcement, there was statistically significant changes in the price and the volume traded of the stock. And it was so common that it was no longer just a fluke. You could see over and over again, these stocks that made these big jumps on news started to show positive activity leading up to the news. And so then the hypothesis, or the sort of thinking, was there were some people that had better information than others. They knew about the deal before it was announced, and they were buying those stocks aggressively, creating abnormal activity. So I graduate from university, and I, at one point, just decide I want to be a stock trader. But I don't want to do it the way everyone else is doing it. I wanted to come up with my own method. And so I went back to that math that we learned in that class to determine if there was a stock trading with statistically significant abnormal activity. And if so, is that an opportunity? And I applied that to those penny stocks that I was trading, the mining stocks, the junior oil and gas stocks. And I found it worked well. I used to hang out at the Alberta Stock Exchange, which back then had a trading floor, and you could look out onto the trading floor, and there was some real-time price quote terminals there. And I would go there, maybe 2 hours before the market closed. You would line up to get your turn on the terminal, and I would go in there on these real-time terminals, and I would extract the biggest gainers of the day, or the stocks that were trading the biggest volume of the day. And then I would race home. I was living with my parents, university student. I would race home, and I would download the chart data and look at a chart and say, or look for what I'm going to tell you to look for tonight, which very simply was stocks that nobody cared about, that were kind of boring and quiet, and then all of a sudden came alive with abnormal activity. And I found it worked really well. And pretty soon I was paying my way through school, and I drove a nice Porsche 911 to university, which probably wasn't a smart thing to do because kids hated me for it. But that's my genesis of stock trading. And I did that, that style of trading. It was very time consuming because the tools to do it weren't out there. They weren't invented. I had to, build Excel spreadsheets, and computers were so slow, and I had to figure out what chart patterns were. There was no books on stock trading. There was some books on futures trading, but because transaction costs up until that point had been very high for the stock market, people didn't really day trade the stock market. They didn't even short-term trade the stock market. It was $400 to do a trade on a stock of when the trade wasn't even that high a value. So it was hard to be a trader. The only way you could do it is if you really could catch stocks that were going to make really big moves. So anyway, I graduate from university, and I decide I'm going to create my own tool to do what I had been doing, and it took me hours and hours a day. And so that's how I started my first company, which was back then was called Orex. And then that eventually took that thinking and that math and that algorithm and started Stockscores back in 2000. So I've been trading the stock market for 30 years. I've been teaching people my method for about 20 years. And what I do today is more or less the same as what I've just been talking about and what I was doing back in university 25 years ago. Now, again, it's more sophisticated now. I'm going to show you my tools now, that sort of thing. But conceptually, that's it. The theory is I want to find market-beating stocks. That's my aim. So what is a market-beating stock? We're going to get into how we find them, that kind of thing in a moment. But first of all, what is a market-beating stock? Well, here's an example. This is a stock listed on the US market, and it went from, just a sec, I've lost my drawing tool and I've got to get it back or we're not going to be able to continue very well here. So just give me a moment. There we go. I have it now. Okay. So here's the chart. And we can see this stock was here at $1, and that was in August. Now it's at almost $6.50. So it's obviously made a huge gain. It has beat the market. The S&P 500 certainly hasn't gone up 500, 600% in that time period. So we call this an alpha stock. Alpha stocks are trading on their own story, and they can move dramatically quicker than the market. And alpha stocks are what we want to find. A beta stock is a stock that's heavily correlated to the market. If the market goes up 1%, a stock with a beta of 1 goes up or should go up 1%. A stock that has a beta of 2 will go up 2% if the market goes up 1. But we're not interested in beta stocks. We are interested in alpha stocks. We want to find those stocks beating the market. They're like the alpha wolf, the dog, the leading dog in a pack. We want to find the leading dogs in the stock market. Now, why does this happen? Well, stocks move in these strong trends because they have significant fundamental change. I'm actually going to qualify what I just said. There is the perception of significant fundamental change. All right. So what I mean there is the market believes the fundamentals are getting better, and they may or may not. There are many stocks that do this. They go up really fast and they go down really fast because it was all perception. It wasn't reality. And so when we talk about pump and dumps or stocks being promoted, they get pushed higher by a promotion process, but then eventually the market figures out that there's really not the fundamental value behind it, and they go right back down again. That's okay. We can make lots of money off of those. Just have to know when to sell. In this case, Resolute Forest Products, I'm assuming they make wood for construction. And if any of you are building a house, you will know that wood prices are at least double, in some cases, like for plywood, triple the price these days. Many mills shut down at COVID, and there's a shortage of wood products. And so these companies are making big money, and that's what's driving this chart. It started here, this recent move in late November, and it's gone parabolically higher because the business is really good. The housing market is strong. People can't go on trips, so they're building houses, and there's a shortage of wood. So you have strong demand, low supply, prices are high, and companies like this are obviously doing well. All right, so that's what drives a trend, but it's the people that followed this company the closest who were the buyers back here because they knew that there was pricing pressure. They knew that there was going to be supply issues. The people that are buying up here are the last to know. These are the retail investors who maybe don't know a lot about trading or investing, and they're coming in late because somebody gave them a tip. They've been maybe watching this stock and they say, wow, 3 months ago it was at $7, now it's at $14. it must be a really hot stock. And so they make the mistake of chasing what we call a parabolic trend. The webinar that I did on Saturday talked a lot about parabolic trends and why you want to avoid those. And if you want to see a replay of Saturday's webinar, just go to YouTube and search for Stockscores. Look at the Stockscores YouTube channel, and it's one of the recent videos that's on there. And tonight's presentation will be on YouTube either later tonight or tomorrow, in case you want to rewatch it. All right, so we know that we want to find these market-beating stocks. We know that it's information or the perception about the company's improving fundamentals that drives these strong trends. Well, the next thing we need to understand is that the stock market is not fair. Stock market is not fair. Not all people get the same information at the same time in the market. Some people get it sooner. If we think about this forest product company, there's people that just know more about this company than Main Street. And so they're the ones that are, buying early in the trend because they have better information. And there's also situations where there's really significant information, like company A is buying company B, this merger, this acquisition. And if you had that information before RJ Reynolds bought Nabisco, you could buy it ahead of time and make really big money. Now that's, of course, trading on inside information. It's illegal, but lots of people do it. There's lots of that in the market all the time. And fortunately for us, the people that know the most leave a trail for us to follow in their trading activity. Now think back to what I was talking about when I was a university student. We were looking at the trading activity of these companies before the big news came out and found that almost all of the time there was abnormal trading activity before the big news came out. I would say today it's the percentage of the time that happens is less because there are tougher insider trading laws and that sort of thing, but it still happens. Stocks move up in anticipation of good news because there may be rumors, there may be good research being done by large institutional investors. They may not know with 100% certainty what the news will be on a new drug or on a mining project, mining exploration, something like that. They may not know with 100% certainty, but because they have experts, because they have the resources to do really good research, they may be able to figure things out before most. And so what we like to do is look for situations where the stock does something that doesn't really make sense. Here, the stock, nobody cares about it. And here it starts coming alive and volume is increasing. And here, very quiet, normal trading. And then it comes alive with abnormal price and abnormal volume. And look what happens. It leads the trend. These are the people that get the best information. These are the suckers, the people that come in late who are hearing about it as a stock tip and maybe not sophisticated traders. They're newbies and they're getting a harsh lesson from Stock Market University. So my approach is to look for this evidence in trading activity that someone has better information than others. But I know that it's still just a probability game. I will never be right all of the time. We are making smart guesses. They're guesses, and they're smarter than throwing darts at a board, but it still has uncertainty. And so sometimes I'll buy a stock because it gives me that abnormal activity and it surprises the market. So it's got all those things I like to see. But then it breaks what we call support and we have to get out and we take the loss. And a big part of being a good investor or a good trader is that you take those losses so that you maintain the number one goal in investing and in trading, and that is capital preservation. So my approach to trading and investing in the market is to always know what my downside is. So if I buy this stock here, I know that if it falls to this level, which is called support, that's my downside. And the difference between the two is how much my risk is. And I don't hold on to losers because those big losers are what crush a portfolio. It's okay to take small losses when you're wrong. Take small losses often, but we don't want to take the big losses. So we don't want to hang on to losers. We don't want to be the person that buys up here and just rides it all the way down and loses a huge amount of their financial capital, but also their emotional capital because they're sitting on a loser and a lot of brain damage for a long time. And then the final concept that's so important for being a good investor is that when we are right, we let the trade work. We have patience in the winners. There's a saying from a book that was written in 1920s or 30s called Reminiscences of a Stock Operator. And that saying is, the profit is in the patience. When you get a winner, let it win. And I think I talked about this stock on Saturday as well. A lot of my students we have a service on Stockscores called Active Live for more active traders. And many of my students traded this stock, and one in particular made, I think, over $400,000 on this stock, maybe even more, by being patient. Bought it early and just let it run as the trend went higher. Now he sold it and bought it back a few times, but generally was patient with the winners. And that's an important concept as well, because you have to remember that your winners have to pay for your losers. I've heard the saying, which I hate, and the saying is, you never go broke making a profit. It's terrible advice because it implies that taking small profits is a good thing. But it isn't, because when you have a winner, remember that the winners have to pay for the losers that will always come. And so if you're right, say 7 out of 10 times, and 7 times you make $100, and 3 times you make or you lose $250, you could say, oh, you never go broke making a profit, because 7 out of 10 times you made 100, that was $700. 3 out of 10 times you lost $250 each time, that's $750 in losses. Even though you were right 70% of the time, you still lose $50 overall because your winners weren't big enough to pay for the losers. So you want your winners to be bigger than your losers and hopefully have a positive probability of winning. You don't have to, though, but that's what we want. So let's get into the meat and potatoes of what I focus on. Sort of implied it a little bit, but when we're looking at charts, we're looking for abnormal trading activity, and the key word is surprise. Tell all my students to take out a Post-it note and write the word surprise on it, because that is always the key thing. We want stocks that nobody cares about, that are boring, and then come alive with abnormal activity, price and volume. They're surprising the market with abnormal trading activity, and that tells us that there is something going on there. But if all you do is look for surprises and buy those, you will not make money. We need to do more. And so we need to understand what predictive chart patterns are and use those patterns, combine them with the abnormal trading activity to pick the very best opportunity. So this is a pattern called an ascending triangle. If you were looking at a stock chart, I'll look at some charts in a minute again. This is an ascending triangle. And then when you get a breakout with abnormal activity from an ascending triangle, that tends to work quite nicely and go up. On the other hand, if the stock's in a downward trend and you have that surprise of abnormal activity, that has a low probability of success. So this is a good pattern. This is a bad pattern. And I teach what those good patterns are. Now, I said earlier that our number one goal is capital preservation. Above all else, we must preserve our capital. And so risk management is extremely important. If we buy the stock here, let's say that's $10, and we see this little floor price here at $9, the difference between the two is $1. So that is our risk per share. If we buy 100 shares, our total risk is 100 shares times $1 a share in risk. That's $100 of risk. How much risk you take is dependent upon your portfolio size, your emotional state, your age, how close to retirement you are, your skill level, many, many things. But the most important thing is what amount of risk allows you to sleep well. And so if you sleep well taking $100 of risk, then you're good. If you sleep well taking $1,000 of risk, then you're good. But you should always keep in mind capital preservation. You know, if you have a $10,000 account and you're taking $2,000 of risk on each trade, that's a little foolish. If you have $1 million account and you're taking $2,000 of risk on a trade, that's not so foolish. That's on a percentage basis quite small. But if $2,000 losses make you nervous and anxious, then it doesn't matter if you have a $10 million account, you're taking too much risk. Another key thing is to be patient with our winners. So when that trade starts to work, and they don't go straight up, they'll have little pullbacks along the way, and they go up, and then they have a pullback, and they go up, pullback. But as long as the upward trend is in place, be patient with that winner. Because remember, that winner has to pay for your loser. Now, we do not aim to get in at the low or out at the high. You know, when I buy these breakouts from these predictive patterns, I'm actually buying the stock after it's gone up for that one day. And some people will say, well, aren't you too late? Well, my probability of success on that breakout day is very good. And so even though I'm paying more than people paid yesterday, the upside potential is good because that abnormal activity from a predictive chart pattern tells me that there's a high probability that that stock will move higher. And at the same time, when that trend is moving up, I'm going to sell it when the trend line is broken. So I'm going to sell it there as opposed to trying to sell it at the high. Trying to sell at the high will usually get you out too early. Selling on the break of trend will get you out off of the highs, but it allows you to stick with that trend. So here is a stock that has all of those things coming together. It had low volatility. It had a good pattern. This is called a bottom fishing pattern. It had abnormal volume and abnormal price. Our entry point is here at $4, and support was here at $3. So there was $1 a share in risk. So if you were willing to take $1,000 of risk, then you bought 1,000 shares. 1,000 shares times $4 is a $4,000 position. Now this stock has gently been moving in this nice upward trend. You can see it runs away from the trend, pulls back and bounces, runs away, pulls back and bounces. So it's behaving nicely. No reason to sell it. Today, the stock is at $580, so it's up to $5,800 for those 1,000 shares. And so on a risk-reward basis, it's up 1.8 times its risk. We call that the RR ratio. So when I teach, you'll always hear me talk about the RR, the risk-reward ratio. And so far, this isn't a barn burner winner because it's up 1.8 times risk. I like to be at least 2. Sometimes we get them where it might go up 10 times its risk. I've had trades go up 20 times its risk. The key is to let the trade work if it is working. So how long does it take to do all this? I'm going to show you in a moment my tools and how we find these things. The tool is called the Market Scan. And if you want to spend 15 minutes a day, then you can do these 4 strategies that I teach. Maybe you only want to put in 15 minutes a week, then you would focus on those 2. Now I say 15 minutes, that's kind of when you're starting out. I do this every day. I take 3 to 4 minutes to do it. Because the tool is so powerful, and with practice, you can go through charts really quickly and find these things in just a few minutes. And we're going to do that at the end of the presentation tonight. So hang around, because at the end, I'm going to go do some market scans with that tool, and we'll see if we can find some stuff. So we use something called the market scan. I'm going to show you that tool in a moment, and then we're going to use it at the end. So the market scan is the tool that I built so that I didn't have to spend hours doing this. Instead, I can only spend minutes. It allows me and any of my Stockscores members to scan the entire North American stock market in just minutes. We've got a number of filters that are very unique to my approach. They're looking for the abnormal volume, the abnormal price action. And the best thing about the tool is it just saves a huge amount of time and allows us to focus on making money. So I'm going to show you that now, and then we'll use it in a moment. Just give me a second here. I have to bring up a browser window. Bear with me. I had it open and then it shut down. Just got a screen off from what you see. So here's the Stockscores website. And we're going to go into the market scan. And this is how it looks. So there's all these filters. So I could say, give me all the stocks between $1 and $20 that made an abnormal day to the upside, that traded abnormal volume, and traded at least 500 times today. And maybe we want to say it's breaking through some resistance. So 15-day resistance, we can say breakout. There, I've just built a scan. And I can now run the scan, and it found 1. So I can then view the chart, and I can see that SMED, you can see it there, made abnormal volume, abnormal price action. This is a pattern called a pennant. It's pretty good. Daily chart looks pretty good. A couple weaknesses here. First of all, the stock has already made a pretty big move. So it's okay though, because it's made a nice base for the last 3 months or so. But we always want to take a look at the 3-year chart as well. When I look at that 3-year chart, I see a stock that's just up a lot in the last couple of years. So it's getting risky. Still looks more likely to go higher than lower, but it's getting risky. Anyway, that's the tool. We're going to come back to it and run some scans later on. Now, also on the Stockscores website is the education that teaches you how to use these tools, what to look for, how to manage risk. So we have something called the Stockscores Education Center. If I go to Trader Training and then to Education Center, assuming you have purchased access to this area, you can go through the theory, which is the foundation. So if you want to learn how to read chart patterns, understand price channels, exit signals, risk management, where to use stops, how to scale into a position, which is adding to a winner, reverse engineering the stock market, how to create a trading plan. All of those are the theory that I teach. For each lesson, there is a written component. So if I click on lesson, you see the quick lesson there. If I click on the video, you're going to watch a video where I explain it, much like I'm doing tonight. I've recorded a 30-minute video here that teaches the different concepts for that particular lesson. And then there is a assignment right here. And there is a quiz, a test. So you can test yourself to make sure you understood the concepts of that particular lesson. So that's the foundation, theory. In addition, there are my strategies. So investor strategies are what we refer to for position trading, longer term trading, where we are holding for 2 weeks to a few months typically, sometimes even a year. I've got some open right now that are almost a year old. And again, there's a lesson and there's a video. There's no assignment, there's no test, because The real assignment is to actually do the work in the market. I teach the exit strategy plus the entry component. Now, those are the investor strategies. And then for those that are interested in day trading or swing trading, we also have videos and lessons on those kinds of strategies. So that's the Education Center. So the investor course is what gives you access to the foundation lessons and the investor strategies. So if you do the investor membership, then you get access to all the foundation material and you get access to all of the investor strategies. Plus, of course, you get access to the tool. The tool is only available to those who have completed the course material. Now, some people will say, well, I already know lots about trading and I don't really need to take the course. I've been trading for 20 years. I just really want to use that tool because it looks really awesome. Well, here's the thing. I don't want to have thousands of people using the tool. And the reason is that if too many people use it, it takes away the opportunity. And I use the tool myself. Like, I'm a trader. I've been trading for 30 years. So I need this tool. And if there are too many people using the tool, then the value of the tool goes down. And so that is why I require that you take one of these courses. I mean, I think it's also important to make sure you know what you're doing. And those courses are designed to teach you how to manage risk and preserve capital. I mean, there's so much important knowledge in there. And the other thing is my approach isn't common. Like, it's not something you're going to read about in, some book that you get from the local bookstore. My approach is fairly unique. And so even though you might have been trading for 20 years, I'm pretty sure you're going to learn something new. And more importantly, by requiring the almost like an initiation fee, we keep the number of users down. I don't want to teach lots of people. I don't teach lots of people. I could easily teach lots and lots of people. I could have staff. I could have marketing departments. I don't do that. I teach a couple, like 100 people a year, and that's good. It keeps the tool running. It's enjoyable for me to teach, and I've been able to help people really achieve their financial goals. So that's sort of my motivation. So with the investor course, you get access to those foundation lessons, the strategies. You get access to those investor strategy market scans. Email support from me. I'm your teacher. When you have an issue as you're learning, you just fire me an email. And typically within a day, I'm going to answer your question. And then if you with the course, you get 6 months access to that market scan tool, which you can renew for $300 per year. Now we have another course called the Active Trader course. It gives you all of that, everything that I just said. In addition to that, it also gives you access to the Active Trader strategies and access to the Active Trader market scans, and also my real-time indicators for TradeStation. Now, I'm not going to go too much into this tonight because I will be covering that in the webinar tomorrow. So we'll just sort of gloss over this for now. There's your highlights of it. But tomorrow I'm going to show you how my day trading approach works, and I'll talk more about what the Active Trader course includes. We have something called Active Live. Again, tomorrow I will go into that in more detail, but just a quick version. I do every day a live webinar where you can see my analysis screen running and see the trade alerts that I am getting from my algorithms. So it runs in real time. It covers all US stocks in real time. Very powerful. I've got really powerful computers running these algorithms. And you get to watch the same screen that I'm watching to pick my trade entries. I teach a little bit every day. I answer a lot of questions. People say, I bought RRD yesterday. Is it, breaking through support today? I think it might be a sell. I give that kind of feedback to those people in there. Again, relatively small group. You have to have taken the Active Trader course to be eligible to subscribe to Active Live. And it's an awesome tool and a great learning tool, but also an awesome tool for making money. But again, we'll talk about that tomorrow a little bit more. So twice a year, I take the online training, so what you saw in the Education Center on Stockscores, and I complement it with some live training. And that's going to start on May 3rd. So there's a few components. Let me go through those. On Monday and Tuesday, May 3rd and 4th, I'm going to go through the theory. At 6 o'clock in the evening Pacific time for an hour and a half, I'm going to do a lesson on the theory. So it's 3 hours in total. We break it up into 2 nights. And I just walk you through the material. So it's the procrastination. It's to overcome your procrastination, because I know that everything's online and I know everyone has good intentions, but this is going to make you learn it. You can go back and go through the education center to follow up, and because everything is covered there as well, but I'm going to make you learn it over the course of 2 evenings. And then the following 3 nights, we are actually going to apply the investor strategies for an hour each night, Wednesday, Thursday, Friday. And all of these sessions are recorded. So let's say Tuesday night you're playing basketball and you can't come to that meeting or that class, you can simply watch the video later. It's better to watch it live because you can ask questions live, but if you can't make everyone, they're all recorded. And what that means is you can watch them as often as you like. You know, a year from now, you can still watch those videos and really, go back and learn things that you may have missed out on. Now then for the active trader students, so for those that want to take the active trader course, which again, I'll cover off tomorrow, you also get 1 free month of active live and plus all of the other stuff. Okay, so that's the bonus that you get right now. And if you took, let's say you bought the investor course, 2 months ago, you're going to get this as well. Anyone taking buying the course between the last one, which was in November, until now, you get this round of complimentary live training. But it's really going to help you learn it quicker and better. And so it's always good to become a student either in May or in October. So the special offer, which I have up until Friday, April 30th at 11 p.m., is you can get all of these extra classes for free from just by purchasing now. So anyone who purchases from now until April 30th is going to get access to that live training coming up Monday, May 3rd, Tuesday, May 4th, and then the rest of the week, Wednesday, May 5th, 6th, and 7th. I got the dates wrong there, but you get the idea. All right. Now the price, $2,495 for the investor course, $3,495 for the active trader course. Now we have something called mentorship. I'm going to talk about that again tomorrow and on Saturday. This is where I teach 20 people, it's a limit of 20, really focusing on the active trader material, but it's 14 one-hour classes that we're going to do between now and the end of June. And more hand-holding, less procrastination. I'm going to take you through it, but I'll talk about that more mostly on Saturday. Okay. Here's some comments that I received. I just pulled these out of my email this afternoon, and I'll leave that up for a moment. Now, what we're going to do in a moment is, first of all, I'm going to put up a poll that you can answer the poll if you want some follow-up information. I'll put that up in just a moment. And then we're going to do a market scan and see just the process that I use to identify opportunities. Okay, so let's do that poll now. I'm just going to put it up. And the reason I do this poll is I don't like to send people email they don't want or bug people. If you have an interest in this course, then say yes, and I'll give you a follow-up email or two, but I'm not going to bug you a lot. It's not my style. I got lots of students. I don't really want thousands. Like I say, I teach 100 people a year, and that's good. Okay, so we'll leave that up for a minute. I'll just give that another 10 seconds. Okay. Now, next the thing we're going to do is the market scan. Okay, so I'm going to get my mouse over here. So the scan I like to run on a daily basis to identify position trades, which are like investor type trades, is called the abnormal breaks. So I can run that on Canada or the US. So we'll do both. So I select Canada, and there's the basic settings. Run the market scan. It just went through every stock that trades on the Canadian market, and it found 4 that meet the criteria, the basic criteria of the strategy. Now we need to check the charts to see if they have the right kind of chart pattern. So here we have Taiga Building Products, another company benefiting from high lumber prices, I'm sure. And there's the abnormal action today, but it's not the right pattern. It was good back here when it surprised the market with a break from an ascending triangle, but today it's not awesome. So we go on to the next one. This is the process. I do this every day. It takes me, to do the Canada and the US market, it takes me about 3 or 4 minutes. When you're learning and you're starting out, it's going to take you more like 15. If I see something that has some promise, I'll usually look at the 3-year weekly chart, but none of those 4 were good enough. Of course, what I teach you in the class material is what to look for in those charts, and we practice that together in those live sessions in May. And I'm going to have one other little special thing, which I'll talk about on Saturday. So I'm going to throw in one more bonus thing on Saturday. But here is the US scan now we've just run. Now, last time I looked at really big charts. Now I'm going to look at smaller charts because I can go through them quicker. So there's that SMED again. And there is the break with abnormal volume, abnormal price action. And as I said, this looks pretty good. I'd give this a 6 out of 10. My concern is that when I look at the 3-year weekly chart, it's already up a lot. But on the 3-year chart, I just feel like it's gone up too much. So let's just keep looking. So I'm looking for something very specific, and you'll notice that I'm going through this really fast, because once you learn what to look for and you've practiced a bit, you can go through charts like 30 or 40 in a couple minutes. Now I see something here that's got some promise, and I then want to look at the 3-year weekly. Problem there is there's some resistance on the 3-year weekly, so it's not ideal. So I keep moving on. Now I do this every day. Sometimes I'll get 10 good stocks in a week, and sometimes I'll get 1 good stock in a month. It really depends upon the state of the market. This one looks pretty good. This is called a bottom fishing pattern. You can see it's breaking from a rising bottom, breaking the downward trend line. However, it lacks volume. See how there's no volume there? So I'd give that a 6 out of 10. All right, so I'm not seeing this Kimberly-Clark. Let's take a look at the 3-year. Nope, not good enough. Now, what I teach in the course material is process. What exactly are you looking for, and where do your eyes go, and how do you draw lines on the chart to see that? And within a couple months of practicing, anyone can do this. It's not very, very complex. Oh, shoot. I've had my poll up the whole time. Sorry. I'm an idiot. Well, I'll go through it really quickly for you again. So let me close the poll. There we go. Sorry, I'll go back and we'll just go through these charts again just to show you. My apologies. So here was SMED, and that's a stock breaking from a pennant pattern. Nice break there. But again, when I look at the 3-year weekly, it's already sort of so well into the trend that it's just getting risky. That's why I said it was a 6 out of 10. This one I don't like. This one's okay, but when I look at the 3-year, it has resistance here, so the upside is limited. These ones are not breaking from low volatility. This is probably going to get stuck at 58 because that's resistance. This one not breaking from low volatility, so we go on the next page. This looks decent on this time frame, but when I go to the 3-year, I see limited upside because it's got resistance at $80. So what is resistance? What is support? These are all things that you learn in the course material. Here's the one that I also thought was okay. This is the bottom fishing pattern. Bottom fishing means that there's a downward trend line, break of the downward trend line, build of a rising bottom, and a break to the upside from a rising bottom. So that is a good pattern. The problem here is that there's a lack of volume, and the upside is limited to this range, so I gave that a 6 out of 10 as well. All right, let's keep hammering through here. And Kimberly-Clark was okay, but when we look at the 3-year, limited upside, so not ideal. All right, that's the process. Unfortunately, we didn't find anything tonight, but we gave it a good try. And you do this process every day. And, you know, in the last year doing this process, I found, well, we can actually look. Why don't I show you this here? Just give me a second. I'm just going to bring up another screen where I've got a summary of my position trading picks. So we'll bring this over here. So that's, you know, basically the last year's picks. We still have some open. So these are our open trades that I haven't exited yet. So the best one is up 91%. The worst is down 21. Those are the current open trades. And then the closed trades are here. Okay, so you can get a quick glimpse of the performance. It's been really good. But I can also go into the analysis tab and say, all right, let's go back a year to 2020, 03. And if we had $1,000 of risk tolerance, I can click on Analyze, and it tells me that my performance, 72% success rate, 53.97% return as of today. Tomorrow might be a little different, but that's where it is now. So that's my sort of performance based on that process that I'm doing every night. So if you would like to register for the course, you can do it anytime. The deadline is April 30th. The sooner you sign up for the course, the more time you have to study. We start our live training May 3rd, so giving yourself a couple of days or a couple of weeks even to study before May 3rd is going to mean that you're going to get more out of it. And so if you know that you want to do this, I wouldn't wait until the end. I mean, you can, but you know, the sooner you get in, the sooner you can start using the tools, and you get instant access. So if you go on to Stocks, I'll just show you how to register. You go on to the Stockscores website, go to Trader Training, learn how to trade. There are some videos here on what each course is about, as well as some notes. And then if you want to buy it, you just click on Order Investor Course and complete the process, and you'll have instant access. So you can start watching videos and lessons tonight. It's right away. All right, so I've got quite a few questions. I'm going to try to answer those, and then we will wrap it up. I just have to get that in front of me. Now, because I screwed up, I had lots of people telling me that my poll screen was still up, so I have to really scroll up here to find the questions that were made earlier. So a few of you are having problems with the webinar. I apologize. There's always, 1% of people that just the sound doesn't work or something. It's not my fault. It's a third-party application, and sometimes it's just a software glitch. But that's why I record this, so you can watch it later. Disnat customers have access to Market Scan. No, they don't. They used to. Disnat, which is a broker in Canada, used to pay me to give their clients access, but that's no longer the case. How many hours are there in lessons? I think it's like 12 to 15 hours. Normally I would teach it in a weekend course. I used to teach this at universities on a Saturday and Sunday, and we'd get through it in a weekend. So it's a little more efficient now because you can watch it as a video and go back and rewatch things that you need to. Okay, what happened here? So all right, so all of my capital is in Canadian registered accounts, so I cannot short or margin trade. Is this a limitation? No, not at all. No, lots of my students are managing their registered accounts. You don't need to be able to short, because nowadays you can buy inverse ETFs, which is how you make money if the market goes down or if sectors go down. And, margin can help you improve performance, but you don't really want to do that in a retirement portfolio anyway, so you can do that. I get the idea that abnormal activity helps identify stocks that are about to go up, but it must be very important to make sure the abnormal activity is not due to people who know something that is about to take the stock lower. Of course, but we're looking for abnormal activity to the upside. We do also see abnormal activity to the downside, which is what telegraphs a good short selling opportunity. So you can take everything I've talked about tonight and flip it upside down. But that's, when we talk about abnormal activity, it's positive abnormal activity for buys. Is it best to start with the mentorship course or active trading course? So the mentorship course covers everything in the active trader course. It's sort of like one is the do-it-yourself and one is Tyler walks you through it. It's the same information. I probably go a little more in depth with the mentorship course, but the strategies are the same. I just, for 14 classes, each class is about an hour long. We do 1 or 2 a week. You just have me walk you through it. And everyone that takes a mentorship course gives me great reviews about it, because they just find it's way easier to learn. But doesn't mean you have to do it that way. You can do it on your own if you're a self-starter, if you're not a procrastinator. By all means, it's the same basic knowledge. Okay, so I think I've caught up. Well, I got so many Tyler, you're an idiot messages for not turning the poll off, but I'm just getting this figured out. Okay. With market at new highs or near NASDAQ anyways, has it been harder to find good picks? Yeah, the market's been pretty quiet, but it's not because the market's at highs. I think it's because we had a real speculative bubble in call it the Reddit stocks, retail traders all chasing a small number of stocks. And that bubble kind of burst. And so some of those people are buried in those stocks now. So anyway, I've been trading for 30 years. Hot markets are followed by quiet markets, and quiet markets are followed by hot markets. It's a constant cycle. Did your folks get in on the GameStop swings? Yeah, we traded GameStop quite a bit. I eventually want to be able to trade full-time with dedication. How long does it take your students typically to go it alone? So many variables in that. Emotional control is the number one variable. You can learn my rules in a weekend, and then you have to practice so you can see the patterns. I think that honestly takes at least a couple of months of practice, and you shouldn't expect that it's going to take you 3 days to be good at it. If you wanted to become a lawyer, you go to university for 7 years. Trading is a much quicker path, and certainly have the same potential income, but you got to put the work in. And I've got students who hammer through the material in a weekend and have the time to put in every day, and they learn it quicker than someone who can only work on it for an hour a week. There's no limit. The videos are yours. I don't want to say forever, but I've been doing this for 20 years, and the people that took my course 20 years ago still have access to the videos. So I don't limit the access, but you got to do the work and work at it at your own pace. So I can't really give you a time. I would say the minimum is probably 3 months. Okay. Sometimes I see stocks pull back to support after the initial signal. How often does that occur? Probably 30%. It really depends on market conditions. Last year, with the great rally we had, it was a very low percentage. In the last 7 weeks, it's been probably more like 40% because the market's been choppy. So it varies, but over the long run, it's probably, you get those pullbacks 30, 35% of the time. For day trading, can you do that and still have a full-time job? Well, it depends what time you work full-time. The most critical time for trading is the opening hour. Second most critical time is the closing hour. And I've got lots of people who, work full-time. Let's say they're a fireman. I've got people in that situation. they work 4 days and then they have 4 days off, so they trade on their days off. Or you've got the flexibility, maybe you're on the West Coast, you can trade from 6:30 till 8 and then go to work and maybe just casually monitor your positions from your phone. You can do that as well. Although in that situation, I would encourage more of swing trading approach. Are these courses tax deductible? They are tax deductible against capital gains in Canada. I don't know what the rules are in other places around the world, but in Canada, you can deduct it as an interest and carrying charge against capital gains. So someone here, Robin, says, take Tyler's course, guys, do the work, follow rules, be disciplined, best investment you'll ever make. Well, thank you, Robin. I didn't pay him to say that. He just put that on here. So I appreciate that. Okay, I think I've caught up on all the questions. If I missed one, you can always email me. But in fact, let me put up my email address. If you have any questions, there's my contact information. Great thing to do is to subscribe to the YouTube channel, the Stockscores YouTube channel. Just go to YouTube, search for Stockscores, and subscribe to the channel. I do at least one video every week. They're free. You'll learn something every week from that, so that's good. I don't do a lot on Twitter, but a little bit. But if you have any questions about the course, which course is right for you, I'm not here to give you the big sales pitch. If you want me to help you sort of decide, I'll give you some information, but I'm not going to bug you. So there's my email address, tylerb@stockscores.com. Just a couple more questions have come in. Do your tools work well with US and Canadian blue chip stocks? Yeah, you can do it with anything. Anything that trades with good liquidity. I tend to favor lower price stocks because they're less capital intensive. But if you're managing your retirement portfolio, you may be more interested in owning, banks and well-established companies. The strategies work for any type of stock. Okay, so I don't see any other questions, at least not that I understand. What percent of loss is acceptable before pulling out? It's not about percentages, it's about the distance down to support. And so one of the things you're going to learn from me is how to manage risk. Some stocks we take bigger positions than others because the stock is more volatile. So in some cases, the drawdown potential might be 30%, and in another stock, it might be 7%. It really depends on the volatility of that stock. All right, well, I'm going to wrap it up there. I want to thank you all for joining me. I hope that you learned something tonight. Reminder, tomorrow we have the day trading thing, and I'll walk through my day trading approach, the active live stuff that we talked a little bit about tonight. And then Saturday, I'm going to go really into depth into what the courses involve and include and that sort of thing. So Saturday at 10 a.m., you can watch that. All of these are free. If you want to register, if you haven't already registered for tomorrow or Saturday, go to Trader Training, upcoming events, and you can register right there. All right, so we'll wrap it up there. Thanks, everyone. Good night, and hopefully we'll see many of you here tomorrow. Bye for now.